does. So we saved a little bit for later. And, to be fair as well, it's not something that you can observe and determine with precision today. As you get closer, we will understand better where exactly it stands, and we will debate it. I have no illusion on that. Thank you.
Thank you. And the next question goes to Dan Balacher of Forex.Today. Dan, please.
Good afternoon. Thank you for taking my question. Is the end of the asset purchasing program a good time for you maybe to adjust the forward guiding policy? Because when it was introduced in 2013, it was meant to manage market expectations. But now it seems like the ECB would have stopped the purchases earlier if not for the promises made, even though there was an extraordinary inflation-inducing event like the war in Ukraine. Is the tail, financial markets, not wagging the dog, the ECB, instead of the other way around? My second question is related to this one. The ECB believes inflation will fall down back to target by 2024. But for most of the past decade, the ECB also consistently thought that the inflation rate, which was then too low, of course, would converge to its target, and that also didn't happen. So how firm are your beliefs that you are going to succeed now, as historical experiences do not imply great credibility?
First of all, on the issue of forward guidance, I'm assuming that you're referring to the forward guidance relating to asset purchases. Yeah. So if you look at that forward guidance, we have actually changed it. If you recall, the forward guidance that we had referred to favorable financing conditions and to accommodative, there was a qualifier as well, but it referred to the accommodative aspect of our monetary policy. We have changed that, and if you look at the third paragraph on the second page, we do refer to the fact that we will do so for as long as necessary to maintain ample, not favorable, ample liquidity conditions and an appropriate monetary policy stance. So we take account of the change that has indeed taken place. And you're right, we are in a different universe. A lot of the tools, the forward guidance, the considerations over the last 11 years had to do with exactly the opposite movement, trying to bring inflation up because it was too low and often at risk of deflation. Now we are in the opposite situation, where inflation is too high and we need to bring it back to our target of 2% over the medium term. Now, how confident are we about our projections? First of all, I'd like to say that our staff does the best work they can do and apply their whole consciousness and professionalism to producing those projections. Second, those projections are not just the ECB. The projections that you have in front of you are the projections of the entire Euro system. So it's the ECB and 19 national central banks, including the great Bank of the Netherlands, which has actively and always actively participates in this exercise. So it's a cohesive work that is done, that is tedious, that is iterative, and that really checks everything. Third, it is clear that the massive energy prices hike and the war in Ukraine and the fast pace of the recovery have taken all forecasters by surprise. You know, I thought you would ask me a question like that. So what did I do? I looked at other, I hope I can find it now. Anyway, it doesn't really matter if I don't find it. The point being that all international institutions, all forecasters of repute have actually made the same mistake of underestimating or not anticipating some of the developments, such as the war, such as the energy crisis. Fourth point, I think we, the Euro system, and the ECB in particular, we are the only central bank which has gone back to the work that was done, which has looked under every stone to understand where the errors came from. And I use the word errors with some trepidation because it's misforecasting caused by very unpredictable events. 3/4 of the forecasting errors is actually attributable to energy prices, and the rest is largely attributable to bottlenecks that have lasted longer than had been anticipated. So, again, they do everything they can as well as they can. They make the same kind of forecast as other international institutions. Events that have developed are not captured in either models or sometimes just the sheer imagination of us all when we talk about the war at the doorstep of Europe. And fourth, we do the introspective exercise of trying to find out where it went wrong, and we will continue doing so in the future because we have to improve, no question.
Thank you. And the next question goes to Mark Schreurs of Börsenzeitung. Mark, please.
Yes, thanks for taking my questions. The first one is on reinvestments. In the past, you've stressed several times the importance of the stock of assets compared to the flow. Now you have reaffirmed to reinvest, especially the PEP payments, principal payments, at least until the end of 2024. That means a huge monetary stimulus for years. Is that appropriate if you, at the same time, are talking about normalizing monetary policy? And the second one, just for clarification, why do you today already exclude a 50 basis point hike in July?
On the reinvestment policy that we decided for PEP and for the APP, both of them will now be operative as of the 1st of July for APP and has already begun for PEP. It is a matter that we will be discussing within the Governing Council, which we have decided not to debate today. We had, as I said, plenty to do already in the last couple of days, but we will be looking at it. And I have to tell you something. There are some of us on the Governing Council who will be interested not only to deploy flexibility, if warranted, on classes of assets, by jurisdictions, over temporality, but some of us are also interested in looking at how we can support the financing of the measures needed against climate change. I said already before that a green LTRO was interesting to consider. I think the reinvestment decisions that we will make in the coming months and years might also be inspired by this concern that we have. Okay? So that's point number one. Your point number two is, why not 15 July? Well, we are coming out of 11 years of no interest rate move. We are on our path to exit negative interest rates soon. It is good practice, and it is actually often done by most central banks around the world, to start with an incremental increase that is sizable, not excessive, and that indicates a path. As I said, the decision that we have made today are not just one intention of one single month of July. It's a whole journey that will take us back to the 2% target in the medium term. We also want to observe how markets are going to operate. And as I have mentioned, we couple our July determination with our September indication.
Thank you. Next question, Martin Arnold. I think you raised your hand, of the Financial Times.
I did. Thank you for taking my two questions. Hello, Madame Lagarde. Could I ask, first of all, is this announcement today a signal that you are dropping gradual normalization in preference for a whatever-it-takes approach to tackling undesirably elevated inflation? And secondly, could I ask on tackling fragmentation that you mentioned earlier, the new instruments that could be designed and launched, would those only be designed and launched once the existing instruments, i.e. PEP reinvestments, have been fully utilized? Thank you.
I want to take you back to the monetary policy statement, because I think that the key principles that we will be inspired by in order to be predictable by you, but also to set the rules according to which we will proceed, are captured on the top of page 2 and say the following. Throughout this process, the Governing Council will maintain optionality, data dependency, gradualism, and flexibility in the conduct of monetary policy. So, all 4 will matter, and there will be circumstances when one might be more important than another, and there might be other circumstances where the pecking order will change. So I think by doing that, we are trying to have as much optionality as we can, be able to use flexibility if and when warranted and necessary, be as data dependent as we have demonstrated and will continue to demonstrate, and also deploy the gradualism that will be appropriate given the circumstances. And I think in times of great uncertainty, gradualism is probably appropriate, more so than if the path is clear, well identified, and we all understand where we are heading. On the second issue, I just want to yet again come back to this issue of fragmentation, because I know that this is dear to some. I just want to reiterate that within our mandate, we are committed to preventing fragmentation risks in the euro area. Fragmented financial markets would obstruct the monetary policy transmission and undermine the possibility for the ECB to achieve its price stability mandate. And that's the reason we monitor constantly. And that is the reason we have available at hand all the dimensions of flexibility that can be applied to our reinvestment policies under the APP, under the PEP, because flexibility conditions are clearly associated with PEP to the extent that it relates to consequences of the pandemic. But we, as I said, we know how to design and we know how to deploy new instruments if and when necessary. We've demonstrated that in the past. We will do so again.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much for taking the question. Given the scale of the inflation, it's no surprise that the ECB is acting. But still, could you explain, it's an inflation that's imported, that's mostly a tax on consumption, really. What can interest rate do against this kind of inflation? And also, could you come back a little bit on why do you not expect too much of a risk of a recession? You did explain a little bit, but could you expand on that, please?
Well, thank you for your question. It is a case that a large portion of the inflation that we have analyzed is attributable either directly or indirectly to terms of trade, what you call imported inflation, whether it is energy, exogenous bottlenecks, that is clearly so-called imported inflation. But it's not it, because we are clearly seeing an unprecedented 75% of the items considered to measure inflation being above 2%. And that applies to non-energy industrial goods, it applies to services, and it is partly a factor of the energy pass-through, but not only. Number two, we are also very attentive to wages, wage negotiations, and to the risk of second-round effect and potential spiraling. We are not seeing the risk of spiraling at all, but we are seeing wage increases that have picked up, particularly since March, and that, as we indicated in the monetary policy statement, would not be entirely surprising, whether it is by way of catch-up effects or by way of general wage increase. We're also aware that Germany, for instance, will implement the minimum wage as of October 1st. So it is largely, and certainly much more so than in the US, for instance, to come back to your questions about the difference between the EU and the US, it is more so imported inflation than it would be attributed to overheating demand, as is probably more so the case in the US. But it's spreading more broadly than strictly speaking, in energy-related sectors. And then, you had another question. You know, it's a bit of a story of, on the other hand, the current situation of the economy. There is probably more of the negative hand than the positive hand, but we have both. And on the negative front, we clearly have the continued impact of the war, in particular, the reactivation of lockdown measures in China, which went away, then are maybe slightly coming back, the bottlenecks impact that it induces and the dampening effect it has. To mention the reduced disposable income that some of the households are suffering. But on the other hand, you have entire sectors of the economy that are recovering. And when you look at the tourism industry, the accommodation industry, hospitality, those sectors are really recovering at a fast pace. And you know, we looked at on a per-country basis at the prices of hotels, of restaurants. It is clearly on its way up, with a strong demand in those sectors in particular. And we cannot exclude also, we hope, you know, that remains to be seen, that some of the factors that have a dampening effect on growth will gradually fade a bit.
Thank you. And the next question goes to Eshe Nilsson of the New York Times. Eshe, please.
Thank you. Good afternoon. You talked of raising all three key interest rates. Is the intention to keep the spread between those consistent as they have been so far? Will that change further into the future? And then my second question is on, can you talk a little bit more about the conditions that would trigger the flexibility within a PEP? And do they have to be specific to the pandemic being the causes? Or could you say that actually consequences of the war in Ukraine or some other shock that we haven't envisioned yet could also encourage that flexibility usage? Thank you.
Thank you very much for your question. In relation to the July rate hikes that we discussed, we certainly considered that the three rates would be impacted by the hike, not just the DFR. For future references, as of September, we might also apply the principle of hikes to the three, but we have not discussed that yet. And I think the intention will probably be to have a close look at that and to determine whether or not we want to just keep those spreads or you know, return to a better symmetry between those three. That's clearly to be debated at either our next meeting or the September meeting. On the conditions that would trigger the anti-fragmentation, let's be clear. The critical point is monetary policy transmission, and we are very attentive to make sure that it transmits throughout the entire euro area. So there is no specific level of yields increase or lending rates or bond spreads that can unconditionally trigger this or that. The principle is that we will not tolerate fragmentation that would impair monetary policy transmission. And we will determine on the basis of circumstances, of countries, how and when that risk is likely to materialize, and we will prevent it.
Thank you very much. I would like to turn now to WebEx and take a question from a colleague in Frankfurt.
Oh, we had forgotten WebEx because you're all here, which is so much nicer.
So Andres Stumpf of Expansion, your question, please. And please turn on your camera and your mic. Andres, for the time being, we can't hear anything.
Can you hear me now?
Yes, wonderful.
Okay, I wasn't able to unmute myself. I have another question, Madame Lagarde, about fragmentation. We are today experiencing a new sell-off in sovereign bonds, and this might point that the PEP reinvestments and maybe the ECB new commitment is not enough to prevent fragmentation. has the ECB any news on how the new or the adjusted tool could even look like? Thank you.
Thank you very much for your question. I can only repeat what I have said, which is that we will not tolerate fragmentation that would impair the proper transmission of monetary policy throughout the entire euro area. We do have existing flexibility that is embedded in the reinvestment of our PEP in particular, and we have demonstrated in the past, we will demonstrate if necessary in the future, that we can design, we can deploy the appropriate instrument to prevent that risk from materializing. Thank you.
Thank you. And the next question will go to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for taking my questions. President Lagarde, I have two questions. One is on the importance of data dependency. And looking beyond September for rate hikes, the Governing Council will adjust the monetary policy and it will depend on incoming data. Can we expect then lift-offs to come on a quarterly basis, coupled with the macroeconomic projections? And my second question is on financial stability, because you mentioned it. You mentioned that banks will be facing credit risks increased due to tighter financing conditions. How concerned are you about financial stability in a war situation? Thank you.
I have to tell you that I'm concerned about the war, full stop, but your question goes further than that, of course, and the financial stability side of the question I will defer to my esteemed colleague, friend and Vice President de Guindos. The first one, yes, we are going to pay a lot of attention to data, and we are considering data dependency as one of the key 4 principles according to which we will operate. And obviously, the quarterly projections that we produce are, very rich, inform our decisions best. But we cannot be unattentive to developments and to data that we continuously collect, both at the ECB and within the national central banks as well. So we are not going to put ourselves in a straitjacket of only taking decisions when we have projections. So with that, I'd like to hand you over.
Thank you very much for the question. You know that in our strategy review, we included a reference that twice per year we would include financial stability considerations in our monetary policy making. And, we did it in December and we have done it now in June. And here, the message is quite clear. The vulnerabilities of the financial system in Europe have been defined in our financial stability review, refer to problems in terms of valuation of financial assets, in terms of margins of the banks, and in terms as well of high valuations in some spots of residential real estate. So the conclusion that we have reached, that is included in the monetary policy statement, is that in the short term, the normalization of monetary policy conditions can give rise to additional stress in the short term, but in the medium term, the tightening of financial conditions could be positive in order to try to address some of the vulnerabilities. Think about residential real estate. So, this is the main conclusion. And, we try to make an assessment that covers not only the short term, but as well the medium term.
Thank you very much, Vice President. That brings our press conference today to a conclusion. Thank you very much for coming here.
I would just like to add something, because we are here standing in Amsterdam, and my colleague Klaus Nord is with us. And for those of you interested, we had just a fantastic meeting that was organized under the auspices of the De Nederlandisch Bank, under the leadership of Klaus, and it's been just a really
they had a charcuterie,
fruitful and productive experience.
Good cheese.
Geography matters, and hospitality can help a great deal. So thank you to the Netherlands and thank you to the...
Wow, that was 2 shout outs to the Dutch. When was the last time the French did that? All right, so let me wrap this up. Let me Spain something. First of all, the media had been predicting 50 basis points. And like I said yesterday and the day before, and I believe the day before that, the ECB has never missed an opportunity to miss an opportunity. So anyways, they're raising by 25 basis points. And I always scratch my head. I'm like, if you're telling us you're raising interest rates in July, why don't you just do it now? Okay. Manos was just there. Hey, did you ride a bicycle with a basket on the front? I mean, that's what you do, right? Well, that, prostitutes and drugs. But riding bicycles over canals, that's another one. What the prostitutes... Anyways, he's like, I rented one for the hotel. Anyways, yeah. Anyways, anywho, all right. I asked a couple of questions, and this is interesting. Okay? This is an interesting thing, because this goes back a long time. In fact, it goes back even thousands of years, some of these discussions. Okay. First question I asked you, what creates inflation? High wages and unions? Makes sense, right? Now, you read this a lot in the media. And by the way, don't let me forget, I want to talk about misinformation. I heard a lot of misinformation today in the news. Fake news, if you want, or misunderstood news, or misreported news, or misunderstood news, or correlation versus causation news. Remind me, but let me focus on this right now so we can talk about what's going on. Okay, what creates inflation? Because, hey, the ECB is trying to fight inflation. So you're like, okay, so what is inflation? High prices. Okay, great. But why? The why is the interesting, right? So anyways, what creates inflation? I asked you, high wages and unions, scarcity of resources or products, the money supply and printing of money, or both money supply and scarcity of resources. Okay, 66% of you are correct. It's both A and B. If you have money and there's very few things to buy, so let's put it this way. You're a millionaire and you have a baby. But there's not a lot of baby formula in the United States right now because one of the 3 factories was shut down. So there's at least a 33% shortage of baby formula or baby food or whatever you call it. But if you add in hoarding, there might be more than 33%. So anyways, it's hard to find baby formula. You're a millionaire. You just pay twice as much. You don't give a crap. Your baby's going to get fed, and a poor person with no money, their baby won't get fed. That's just how it works. Okay? Prices go up because there's a lack of supply. So whoever has the highest amount of money gets what they need. Prices go up. Now, money supply and printing money also does it because your money pays less. When gold was money, guess what happened when they discovered gold in California? More gold was found. Therefore, you needed more gold to buy stuff. Therefore, we had global inflation. Why? The amount of gold went up. So now our money's not backed by gold. Okay? So the money supply and printing of money, and it's really actually more the printing of money, but we'll get there, okay? But they're they're sometimes the same depending on your technical use of the terms, but it's the printing of money, and okay? So it's B and C, not just scarcity and not just money supply. Okay? But notice it's the supply of resources and the supply of money. It's not demand. Okay. Then the next question I gave you, who creates inflation? Governments, consumers, central banks, unions. Now, a lot of people in the past, so if you go to the period of like, let's say the 70s in the UK, they had high inflation and unions were at the top of the political discourse of society. And it's sort of like von Hayek versus Keynes, if you were around in that point. Okay. Margaret Thatcher actually hung out with von Hayek. And if you don't know who that is, Google it. Okay. Hayek. H-Y-A-K. Anyways, unions don't drive up wages. And you're like, but wait, they're always trying to get companies to pay more. No, but that's them trying to address inflation. Okay? They don't create inflation from the higher wages. What unions, in my opinion, do is lower productivity. And the lower productivity, if you get a high wage, but you work half as much, now you're creating inflation, but not from the wage. It's from the decline in productivity. And if you're like, well, what does that mean? Well, the whole Soviet Union was one giant union and they had very low productivity. Another way of looking at it, because I'm an entrepreneur and I'm from a high-tech startup background, so like you hustle and you're going to change the world and maybe you'll get filthy, stinking rich. But when I see unions, you get the better job or the higher pay raise because you've worked there the longest. Well, what the hell is that? Not because you're the best, the smartest, the brightest, or the most productive. You get more simply because you've been around longer. I don't agree with that. And one great example is, I'm a platinum member on Delta Airlines. When I fly internationally, okay, I sit in first class. Hey, look at me. Look at this face. Of course it sits in first class, right? So what happens? They're not really a union, but they kind of work with you, like in a union model and a lot of airlines do this, where there's seniority. So what happens when you travel internationally? The best routes, the most expensive seats, you get the oldest people I've ever seen. You're getting like senior citizens working these routes. I'm not joking. I saw one steward that was so old on Delta Airlines serving first class, he shouldn't actually have been working. He was shaking, he was old, he was frail, he was brittle, he couldn't do anything. And I'm like, what? And the other woman serving me was also on the mature side, aka Mighty Silverback. And she comes up, she's like, what do you can I get you something? She was polite. And I'm like, well, what kind of bourbons do you have? I don't know. I don't drink. I don't know anything about bourbon. I don't know whiskeys. What kind of answer is that? Like, dude, tell me a story. Oh, we have the best whiskey in the world. I'm so well trained and I'm so nice and I'm going to hustle and I'm going to make you so happy. I'm the best employee in the world and that's why I got the best route. No. Why did she have the best route? Why did he have the best route? They've been working for 75 years at Delta. It was a biplane made out of cloth and wood. That's how long they've been working at Delta. So anyways, I look at that and like, no, you should get the best route because you offer the customers the best service. So anyway, so I say, unions, if you're using seniority as sort of a base model for how you manage your employees, all you get is lower productivity, lower quality. So not inflation creating from wages, which is most what people think, but maybe inflation creating on the longer term from lower productivity. But that's a much longer term kind of argument. But what I'm trying to say here is it's not because they're driving up wages. The wages are going up because the union members are getting crushed by inflation, and therefore the bosses go in and get wages increased. Okay, so it's wages going up from unions is a cause of the inflation, but the inflation is always there first. Central banks don't create inflation because when they stimulate the economy and they increase again, this is where like money supply and printing money gets complicated, but they can create and then destroy money. It's okay. They can like add some juice into the economy to get it going when there's a recession. And then when there's no recession, they remove the stimulus. So they add a little stimulus when you need it, and then they withdraw it when you don't need it. Nothing wrong with that. Okay? Consumers. So right now, hotel prices in Florida are up 55%. And nationwide in the United States, they're up 33%. Gasoline prices in like 7 states are above $5. It used to be $1, $2, then $3, then $4, and then $5. You know what? People are still going to drive. They're still going to stay in hotels. They're still going to go to restaurants. They're going to pay the higher prices. It doesn't matter. Do you know why? Because their family and relationships and basic needs, like they're still going to drive to work regardless of the price of gas. The basic needs of society have to be met regardless of the price. They didn't create it per se unless what? They have BS money. How'd they get the BS money? Okay, your income is attached to productivity. What you produce, you get compensated for, then you go spend that compensation to buy shelter, food, and other needs, which turns into someone else's income, and they got that income because they produced those things that you bought. And it goes on and on and on, around and around and around. GDP is equal to GNI. The amount of that the country produced, that's how much money you got. Your income and your productivity is better, are tied. Now, if somehow you figure out a better way to combine GDP, right, which is, if you look at productivity, what are the factors of production? And it's capital and labor. So an entrepreneur comes around and says, you know what, let's combine these things in a better, unique way, and we'll get more productivity. And what that does is lowers inflation. So then what creates the inflation? Money that didn't come from GDP, which is equal to gross domestic income, is equal to gross domestic product. Productivity and income are equal, like savings and investment are equal. It's all the same thing. You don't save money, you put it in a bank, and a bank invests it and into a mortgage. So now your savings is someone else's mortgage-backed security, right? So anyways, so savings is equal to investment, productivity is equal to income. So it can't create inflation. It all balances out. Unless a government, and this is the answer, unless a government comes in and says, you know what, we have a problem. Some people need money. It can't be everybody. It can't be everybody because the GDP doesn't go to like actual productivity doesn't go to zero. Now you might say, well, you could have negative GDP relative to the past, but you're still producing something. Now, if every single person in the economy lost their job, we'd have zero productivity, we'd have zero money, and we'd all be in a world of hurt, right? So anyway, so not everybody needed the money. So what happens is the government printed money and added money to the economy, but productivity not attached to any productivity. So you got no increase in productivity, but more income. And now that money in the economy, there's more money. The value of the money went down, and that's what created inflation. The government, only the government, or the king, or the queen. Okay, the king, queen, or the government creates inflation. So I made some purchases recently. I haven't got some of them yet, but I bought coins from World War II, showing ways that the government can create inflation. One of the things they did is they took a silver coin, and instead of making it out of 100% silver, they started making it out of 35% silver. But it was still had the same monetary value stamped on it. which means they can have 66% more of those coins for the same cost. So the coin exchange value is still the face value, but the intrinsic value dropped by 66%, and therefore the government can make all that more, right? All that more money. And now if they actually did that, then what happens is that coin buys less because there's more of those coins. So it buys less because more people have the coins and they want to exchange it for candy, right? So then candy prices go up to the point where you're right back to where you were. Nobody, that coin is now worth less, which means prices have gone up, which means inflation has been seen. And so it was a short-term fix, but a long-term problem. Okay. I also bought a coin where I think more than 50% of the coin is made out of copper from recycled bullet casings from World War II. So one of the coins is made out of just less silver than the past. And now there's no silver in these coins. So inflation's gone up. But imagine instead of actually having gold, remember going back to then, these coins from the 40s, money was gold, remember? A dollar bill was a depository receipt against gold. So your dollar represented gold, your coin represented silver. So all of a sudden in the 40s, less and less and less and less silver went into the coin, but they called it the same amount of money. But I thought silver was the money. And same thing, now we're not even on a gold standard, but your dollar used to be worth gold and now it's not, now it's worth whatever. And so anyways, government created that, and there's different ways of doing it. Back in the day, less and less silver created inflation, and then less and less gold created inflation, and now just more and more of the paper, the printing of money has created inflation. But if you do economics, economically, you can't create inflation. It's impossible. You can create deflation by better technology or deflation by global trade. And you might say, well, you're just taking advantage of someone else's lower wages and stuff. Well, don't worry about it, because wages actually for them go up, but it's the specialization. What's specialization? Increased productivity through economy of scale. And the prices fall and you trade with each other. Okay? We'll send you airplanes, you send us bicycles. Airplanes, we make a lot of airplanes and we do it really well. You'll get a better airplane for a lower cost than you could do on your own. And you make bicycles and you'll make the best bicycles, and per bicycle will be cheaper and we're better off in terms of trade. So capitalism doesn't create wages. Inflation. Employees don't create inflation. And when they consume, they're just spending their wages. You understand? So you can't spend more than you earn or you go bankrupt. But what if you borrow and then put it on your credit cards? Well, you're kind of just creating money. And you're inflating your lifestyle with BS money. And then when you go bankrupt, you live in a cardboard box behind a 7-Eleven. So for a while, you inflated your lifestyle with BS money. Well, the government does the same thing. Okay? You see? Now, here's the paradox. The government, let's say, lowers taxes. Or the government prints money. It's kind of the same thing. You're like, what do you mean it's the same thing? Well, if they print money, now you're richer. You go into a higher tax bracket and you pay more taxes, which goes to the government. Which means maybe you actually earn less. It's a tax. It's kind of weird, right? Okay. Okay. Governments can create scarcity if they destroy food. Well, yes, and that's actually kind of what, kind of what happened. Like, for example, if the government, so the United States is about to do quantitative tightening, which means they're going to sell bonds. Well, what about companies that are trying to raise money? They're selling bonds too. So now, U.S. companies trying to raise money so that they can employ workers, make products and services, and eventually actually lower inflation because they're adding to productivity. You got to think about it that way. They're being more productive, so it'll lower inflation. However, the government's coming in as a huge seller. In this case, it's the Fed dumping their bonds on the market, sell, 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 sell. Meanwhile, a company is trying to sell a bond so that they can make it productive. But there's no productivity attached to the Fed selling bonds. So that could be an interesting thing. That's called crowding out. Okay. Okay. Wayne, I want to create shorts and videos of lessons of your videos. I don't think so. No. Sorry. At first thought, no. Okay. Anyways, but thank you. I appreciate that. So how about the fake news? You guys want to talk about fake news? Okay. Thank you for that. Okay. Even paper money, plastic money, crypto money. Yeah. Right. So Anurag says, my issue isn't money. It has to be, whatever you're getting paid with, whether it's cash, Bitcoin, dollars, Kugarand, whatever. It has to be attached to productivity, because then the more productive you are, the more money you get, but the more productive you are, the less you need money. It will balance out. It's supply and demand differentials. Okay, cool. All right, fake news. News number one that I heard today. Mortgage applications are down 18%. And this proves the U.S. economy is about to go into recession. Has anybody heard this one today? Fake news. And by the way, I'm not doing a political radio channel. Although maybe I should. No. So I'm not coming from a conservative point of view, a liberal point of view. If I was anything, I would probably be a libertarian. And I have a libertarian friend who goes to libertarian events. And I'm like, dude, if you put me in charge of the Libertarian Party, the first thing I'm going to do is change the name, because nobody gets it. Why don't you have a cool name like the Tea Party or something? Like, like people knew that, but they don't understand. They think liberals, they think, men with ponytails, and music teachers. Sorry. No. That's not what it's. They're closer to the opposite of that. So anyways, I'm not coming from a political point of view. I just want to know if you heard something like this. Okay? Because the first part is mortgage applications are down. It might have been 16%, 18%, whatever. And then it's framed around this idea that shows that the U.S. economy is going into recession. We should all be worried about this. This is all bad. Bad. Okay? Yeah, hippies with guns. It's not that bad. I kind of like that. All right. So nobody heard this? Really? You're not following mortgage application data? Oy vey. All right, well, that's the bigger red flag. But anyways, let's go with this. How about this? Let me ask a different question. If Bloomberg, CNBC, and other news outlets report mortgage applications are down 18%, and they say that that's bad that's a sign of the economy worsening, do you think most people would take that at face value as being logical? Oh, I guess I should start worrying about the economy. How about that? Yes or no? That's what most people would interpret, right? It kind of makes sense, doesn't it? People are not buying houses. That's bad, right? That's the problem with how it's being reported. Mortgage applications are not necessarily people buying houses. People not buying houses because they don't want to would be a problem. I agree with that. Mortgage applications are not necessarily that. So let's break it down. Thank you, Barry. Can we do cable real quick? No, I have to finish this. Hang on. Okay. Mortgage applications include refinancing. But interest rates are going up. So who the hell would refi their house? They already own the house. You have to understand that. They already own the house. Why the hell would they refi it at a higher interest rate? Nobody would. Therefore, mortgage applications, new homes that you want to move into, right? Or one that you want to buy. But if you already own it, you wouldn't refi it. So mortgage refinancings have gone to basically zero. However, prices of houses are up. Prices for the mortgage by higher interest rates are up. So the behavioral effect of this, if you get a new job in Los Angeles and you work downtown and you only can afford, let's say, $1 million house, you just have to live farther away from downtown to get a decent house for $1 million. That's what happens. But you still have to buy a house. And you're going to buy a house. So anyways, second fake news, Tesla production in Shanghai is up 300%. Should we buy Tesla? Wait. Okay, wait. News outlets. Productivity at the Shanghai Tesla plant is up 3 times. Tripled? It tripled. Wait. Last month they didn't make any cars. Maybe they made 1 car and now they made 3 cars. Oh my God. Misreported, right? Like that's misleading. And most people would say, oh my God, that's good news. So what's the real question? How much did they produce before it was shut down? What was a normal month and then what was now? So they said productivity at the Tesla plant in Shanghai tripled. That's good news. Wait. The reported month versus the normal month was actually down 50%. I would have said productivity, right? Production at the Tesla plant in Shanghai is down 50% from normal. That would be accurate. Triple. They're saying 300%. I'm saying negative 50. Big difference. Anyways, misreported. So you got to be careful, man. You got to be careful. All right, Barry. All right, Barry just bought me a Cohiba. So, by the way, Barry, maybe it'll be cheaper. Send me a Bihike from London. All right. What do you want? Pig dog? All right, pig dog. See? Huh? This is it. What's up? Let's take a look. What's going on? Nothing's right on tone. Okay, well, it depends if you're a bull or a bear. Okay? there's a lot going on the bearish side. Okay. Don Pablo says you got to do your own research. Well, my advice to you is don't take economic advice from a journalist major. Okay. So anyways, do you believe this is continuing? Things involved here. Typically, if the 55 is in control, it does a double bottom or a lower high. Or sorry, no, high or low. So it's usually one, typically it's closer to a double bottom, but it can do this. So we're caught in this key zone right now. So let's just focus in on that for a second. Okay. Now this will be influenced by your bias. Okay. If you are a bull, and maybe you're bullish on pound or bearish on US dollar. I could understand your logic on either. Your trade plan for the month of June is this. And you're saying high or low. Okay? And so this is your plan. And today's event risk has not changed that. In fact, you might have bought off the monthly central pivot. Your current target is 27. Your aggressive target is 130. Yeah, it's actually 27.5. So you're setting, let's say, a limit for Friday to get out at 27.50. If you want to hold it for 2 or 3 weeks, you're going to go to 130. Okay, Barry? Now, if you are a bear, wah, 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 what do? Okay. Your first trade was there. You should have done that on the June 1st or May 31st. And you are looking to keep, I have to zoom in here, but I want you to get the logic. You want to keep this as your highest high. It's actually a lower high. So if you sold high and the lower high holds, then the next move is lower low. And you might be targeting an M1, which is exactly what I have here. And that's approximately a double bottom. So I don't think you have to hit M1. It probably would hit it. But really, I think you should be seriously concerned about, you know, this 121.50 to 125, 122, somewhere like that. So I'd have to drill in. Let's drill in a little bit. Okay. If you're a bull, you're really happy with what's happening because this is the bottom I had talked about earlier. And we had event risk that has tested that bottom and it held. And you're on your way to 130. Cool Mo-D. So from that point of view, tomorrow, I'm talking about tomorrow now, you'll probably get a scenario like this. So you should already be planning. So it'll go back up to here. It won't be a higher high, but we'll call it what? A top. We'll call that top. But then you're projecting, because the event risk is now over, you're projecting a higher high, which means you'll hit a top. It'll respect the top. Why? That's why it's called a top. And therefore, tomorrow's buy zone will lift higher and will be about there. You don't see it because I have this set up as a bear. But right now, as a bull, you probably would be buying tomorrow around 125.50. And you're like, but we're at 125.50 now. Well, you could buy it now, but the probability is you'll be back at break even. Then you'll get knocked out at zero, and then it'll go up and you left money on the table. And you know that's happened before, and maybe that's why you're a bit early. Okay? Or you just hope you survive the pullback, or you hope it breaks this time and doesn't come back, in which case you'll buy again on a retracement of 126. Set from a bearish point of view, ooh la la, you got to sell high. and the monthly sell is here. You should have sold here. Dude, it's obvious. You're like, well, I wasn't a bear there. Well, okay, great. So what about this week? This is this week's sell zone. So this is a sell, and this is a sell. And then right now, though, we're not in a trend. So how do you handle that? Well, if you're not in a trend, you're in a range. How do you trade a range? Well, first of all, you identify the top and bottom of the range. And by the way, it goes all the way back here. You identify the top and bottom of the range. And if you are a bear, you have two choices. You got two choices of what you can do. It's not a tough decision, as you can see. I can blow you away, or you can ride with me. I said I'll ride with you if you can get me to the border. The sheriff's after me for what I did to his daughter. Okay, cool. Okay. Okay. Forex pivots. Yeah, you're either a bull, a bear, or a pig. And that's a pig right there. And pigs get slaughtered. So anyways, if you are a bear, I have this set up as a bear. This is a bearish sell here on a monthly point of view. This is a bearish selling zone from a weekly point of view. On a daily point of view, we lack trend. So how do you trade this now? Well, since we're lacking trend, we're range bound. Therefore, bears sell at the top or bears sell after the break. So you either sell here or you sell here. And you're like, but Wayne, that's the bottom. It won't be then, because what'll happen is you'll sell at the top, it'll break, it'll pull back, and you will sell again. Or like that could be your first trade, or this could be your first trade, or this could be your second trade. But nonetheless, that's how you trade a scenario like this from a bearish point of view. And you're like, but how do I make a decision on whether I should be a bull or a bear? Join FX Bootcamp. If you don't know how to answer that, I don't think you're going to survive the next 2, 3, 4, 5 years of Forex trading. A lot of people argue against that and say price action and technical analysis is enough. And I'm like, yeah, it is actually enough. But, oh my God, being able to do the analysis, the predictive analysis, building models, building ideas, understanding why money is flowing will certainly not hurt you as a currency trader. Cool. Okay. By the way, I talked about these purchases I made in regards to coins being defaced and devalued. And of course, at periods of time when suddenly inflation spiked in the United States, but it's true of any other country. When we found more gold, there was more gold. You needed more gold to buy the same thing because everybody had gold or more people had gold. Prices went up. So you needed more gold to buy the old thing. And we call that inflation. Why? The supply of gold went up. Well, if you're making coins out of less silver or no silver at all, and you, right, then you're and then therefore you can afford to create more money. Then there's more people with money, prices go up, there's no productivity attached to it, and all of a sudden everything kind of, okay. The other thing I'm doing right now, I'm creating a course on how to trade oil. Right now, I've done a whole overview of the industry. The next thing I thought I would do is, now that you kind of have an understanding of the industry in general, before we do a deep dive and get into the weeds of every single little piece, I thought I'd do the entire history of oil. Okay? But one of the points I wanted to make, and I brought this thing out. Does anybody know what that is? See, when I say, what is oil? People think fossil fuels, so they say dinosaurs. Okay. When did dinosaurs live? When did the Megasaurus live? Let me just pull one out. Okay. Triceratops. By the way, I'm trying to whet your appetite for learning more about how to trade oil. Okay. Triceratops lived 68 million years ago. Yeah, Forex pivots, I can do that. What do you think about this? 68 million years ago, the Triceratops lived. Is that where oil comes from? Does the oil come from dinosaurs? Wah, wah, wah. No. Fossil fuels. So I want to show you something. Let me show you something. Hang on. Let me show you this thing. Do you recognize this? Dude, it's so heavy I can barely. I'm starting to shake. Look at this thing. Okay? It's real, by the way. See? It's real. This is a fossil. It's not really a snail because there was no earth when this was alive. There was no land. And if there was land, there was nothing on it. Maybe bacteria. But I think at this point there was no land. How old is this thing that I'm holding? How old is this thing that I'm holding? It's beautiful, isn't it? Again, I'll let you look. Isn't that beautiful? Oh my God, it's so beautiful. Abdullah is 40 million years ago. Take a guess. Is it an imitation? No, it's 100% real. Look, there's the back of it. It's real, dude. That's seafloor. That's marble. It looks like marble. Yeah. This is 400 million years old. No joke. 400 million years. 400 million. Now, that is not a lie or an exaggeration. That is not fake. That's not a mock-up. That's real. And I'm not even sure that's old enough to have been a potential candidate for petroleum. The stuff that petroleum is made out of is probably way older than that. It would be microscopic creatures and bacteria and so on and so forth. So it was on the ocean bed, Don Pablo says. That's so old, the entire Earth was probably under ocean. And then later, what happened, if I remember my geology correct, there was a lot of land for a long period of time, but there was nothing alive. And then amino acids came together in primordial goo and created a protein. And then proteins were created, and later on it took a long time, obviously, but at some point, the whole Earth would have just been a swamp of goo and muck, which became proteins and then single cell organisms and all this billions of years going past to create more and more sophisticated things. And then, an atmosphere eventually created from all the gases coming out of the center of the Earth and all that kind of stuff. and eventually oceans were created and then covered all the earth. And then the plates started to break and move under the changes in pressures. And then that started to move, and then all of a sudden it came to the surface. So there was a period of everything being underwater. Then there was, a period of no water, then everything underwater. And then the plates started moving. There was time when then, all the volcanic gases and stuff heated the earth, and then again turned everything into sort of swamp. Can you imagine the entire planet being swampy and mucky? And at this point, there's proteins and single cell and maybe a little bit slightly more complicated cell organisms. Maybe there's some like plant life and plankton and stuff that lives at the bottom of a swamp. If you've ever been in the bayou in Louisiana, imagine just scooping that muck up out of the bottom of the swamp, but it'd be teeming with life. And I think that period of time is where all of this comes from. Okay? Okay? Forex Pivot says, we came from God, not from goo. Maybe God created goo. Who are you to judge God? I don't know. I haven't met him yet, so I don't know. But anyways, I'm not here to challenge people's beliefs. I'm trying to say, where did it come from? And it is organic matter. But I know a lot of people that would say, that's not 400 million years old because the Earth's not 400 million years old. I'm not here to say that one or the other. I was told by fossil experts, I don't know anything about fossils. Okay? But I'm told it's 400 million years old. Great. So anyways, that's where oil comes from, and significantly older than dinosaurs. So imagine this, you take the course at FX Bootcamp, you're going to learn how to trade oil, and you'll know everything about the upstream, midstream, downstream. You can draw on diagrams how fracking works and how oil sands work and the technology, and you can explain to people how crude oil turns into stuff they're putting on their face, the clothes they're wearing, and you can explain to them how food is grown. The food they're eating has been grown with products created from oil. Well, actually, technically, natural gas. Wait, natural gas and oil, there's a relationship? Let's talk about that. So you're going to know all of this stuff. But when someone says, oh, well, it's just dinosaur bones, you can correct them because you're going to be a genius or annoying like me. So you can explain, well, that's not actually correct. And then when somebody says, well, fracking is bad, and you're like, yes, that is true. And it's bad because this and this and this, but it might not be so bad because of these other things. And you should know these things. And someone's going to ask you about fracking. Someone's going to talk about cracking. And when someone talks about jet fuel, you can say, oh, do you know how jet fuel is created? You'll know this stuff. When you see a pump jack in the field and you're driving across territory somewhere on God's good earth where they're drilling oil, you can explain to the passengers in the car with you how the whole thing works. That's a pump jack. What is it doing? And then where does that go? Like if it's trying to get oil out of the ground, I don't see no oil. Oh, well, it wouldn't gush. Well, what is happening? Oh, well, it's coming out here and it goes to this thing and this thing happens and then it takes it to there and that other thing has happened. And then this nat gas gets siphoned off and a truck will come by, load up on the nat gas, and the guy that owns the land gets paid. Cool, but where does the truck go? And when it unloads, what happens? And you'll just know all these things. And we haven't even got to the chart yet. We haven't even got to the EIA, IEA. How about the history of OPEC? So anyways, that's where we're going. And I thought this 400 million year old fossil would put things into perspective where that's not nearly old enough. Okay? So anyways, I'm doing a training course on oil. I hope you attend summer school this year and learn everything there is to know about oil. Enough Stuff says that's what makes limestone. Well, sure, you're going to need sandstone with calcium added to it. Where do you get the calcium? Seashells. On the seashore. And Shelley sells seashells by the seashore. Okay? Okay. So anyways, I got to go, yo. Tonight is the swing trading group. So day traders and swing traders are gathering at FX Bootcamp to talk about the rest of all of next week and the rest of the month. I have to keep it 90 minutes or less today. I have some time constraints. So instead of 3 hours, it'll be 75 minutes. And therefore, we will not do group work. We'll just do a hustle through the charts, and I'll answer people's questions, and we can address people's needs as needed. So I thank you for your patience with that. Okay. Okay. Forex Pivot Point says oil comes from the great flood in the Bible, and it's all the plants, animals, and humans on earth that have turned to oil. Okay. Okay. Fine. Peace on earth. May the pips be with you. May our profits be above average. Okay. Cool. Yeah. And if you love cheap stuff, actually, I like expensive stuff. Why would you want a cheap, whatever they're trying to sell, that spammer? Why would you want cheap? Oh my God. Oh, Forex said humans didn't say that? All right. Well, there were humans. What? You're saying plants and animals turned to oil, but the humans didn't? Why? God separated the humans from the animals and said, donkeys become oil, but not ogres. Anyways. Just having fun. Yeah. No disrespect meant. All right. Anyways, peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day, y'all. See you later if you're on my day trading group, swing trading group. If not, visit fxbootcamp.com. Cheers.